Friends, a very happy morning, happy afternoon, happy evening based on what time you're watching this lecture. Friends, we'll be discussing your amendments which are relevant for your May 2022 exam. So, this video is all about your amendments which are there for your May 22 exams in your indirect taxation. And friends, our scope would be discussing all those amendments, whether by way of notification or notification converted to rules or section notified between a date or EON orders, all those things which came between 1st of May 2021 till 31st of October 2021. So, between this time limit of 1st May 21 to 31st October 21, the 6 months time, all those amendments which came are relevant for your May 2022 exams. So, be very specific that our scope would be discussing amendments between 1st May 21 to 31st October 2021. Now, one very important point that I would like to bring to your attention. When you talk about amendments, you will find that amendments would even cover your circulars. So, normally when ICAI gives your supplementary material, they do even discuss a lot of circulars which are though not in essence law, but it clarifies what is the stand of law. It is only clarificatory in nature which are issued by your Central Board of Indirect Taxes and Customs. So, if you see the ICAI supplementary material, it covers that, it also tells the same scope that we have discussed now, that they are going to discuss the amendment between 1st May 21 till 31st October 21, etc., etc., including circulars would be discussed. But surprisingly, when you go through the supplementary material, you will not find even a single circular. Now, that being the case, we also have decided to go strictly in terms of your ICAI's understanding that we are not discussing those circulars. Obviously, circulars would have added to your knowledge, added to your understanding, but when the same is not covered by ICAI, we are not discussing the same, right? So, that caution is an important caution. Hardly circulars would have added another 10 pages of the amendments, but nevertheless, we always have a point from our students that telling that sir, conceptual part is too good, everything is too good, but when we have 8 subjects and when you give extra points in many areas which we usually give, then it burdens the students. So, we thought that okay, why not make sure that we go as per ICAI's coverage. Obviously, extra points would have added to knowledge, but thoughtfully understanding the fact that 8 subjects are there for a student, we are ignoring this circular because they are not covered by your ICAI supplementary material. Now, friends, let us start with the amendments in your exemption chapter. So, when you talk about amendments in your exemption chapter, very few amendments are there. Moreover, there are few clarificatory amendments are there, and hardly 2 extra points have been added in your exemption notification. Now, let us see that amendments in your exemption chapter. Now, we have given the amendments in exemption chapter based on sector. Right, so it would rather simplify the amendments more. Now, when you talk about sports sector, in sports sector, there are few amendments when you talk about exemptions for services which is given in terms of notification 12/2017 CT rate read along with notification 9/2017 IT rate. Basically, we are discussing amendments in exemption notification for services, and the notification that we have discussed covers that is 12/2017 central tax rate read along with 9/2017 integrated tax rate. Now, in sports services, first amendment that they have added, rather we can categorize the amendments into 2 parts in sports sector. First 2 point is 1 and third point is second one. Now, what is the first 2 points? First 2 points is rather talking about Asian Football Confederation, right, which is going to organize a very important event called as Asian Football Confederation Women's Asia Cup 2022, which is going to be hosted in India. So, that is going to be Women's Asia Cup 2022 hosted in India, which would be under Asian Football Confederation. Therefore, what they have said, any services provided by Asian Football Confederation, that is we will call it as AFC, or provided to, whether the supplier is AFC or the recipient is AFC and its subsidiaries, directly or indirectly, the scope is too big. See, first it is services provided by AFC in relation to Women's Asia Cup 22 in India, or services provided to AFC. So, it is both by AFC as well as to AFC. That is first important point. Second is not only AFC but also its subsidiaries. So they don't stop at Asian Football Confederation, they even cover the subsidiaries. Not only that, they also tell that directly or indirectly. So if you see the scope, they have expanded the scope very much. They wanted that. So first you will find buy-in to, then you will find AFC and its subsidiaries, then you will find directly or indirectly. Related to what? Related to your Women's Asia Cup 2022, which is going to be hosted in India. Obviously, what will happen? It should be under some government control. So all those services should be notified by whom? Should be certified, not notified, should be certified by Ministry of Youth Affairs and Sports. So Ministry of Youth Affairs and Sports will certify that yes, these are the services directly or indirectly related to Women's Asia Cup 2022. Right. So that certification will be given by a government body, government ministry rather, Ministry of Youth Affairs and Sports. So that is point number 1. Again, point number 2 related to the same Women's Asia Cup 2022 is right to admission. Obviously, when the event will be there, people will buy tickets and watch the event. So right to admission to the events organized under Women's Asia Cup, which is by Asian Football Confederation, that would be that. So again, first portion is services buy-in to AFC or its subsidiaries directly or indirectly. Related to what? Related to an event. What is that event? Women's Asia Cup 2022, which is going to be hosted in India. Second part is nothing but you will go and watch that particular event. So people will go buy tickets in large numbers and watch that event. So even that ticket, right to admission to that events organized by Asian Football Confederation for Women's Asia Cup 2022, even that is being exempted. Obviously, the logic is pretty clear. They do want to promote football, and rather they do want to promote even women's football. So the objective is pretty clear that India has to move on not only from cricket, not only to kabaddi, it has to move on even to football. So they want that sports enthusiasm not only for cricket but also for other sports. Specifically here, they want that to be shifted to some extent to football as well. Right. Now, there is another category of exemption under sports sector which was given long back, but it is now extended due to COVID. Now, what is that exemption basically? That exemption, friends, is talking about again the same language, services provided by or to Federation International Day Football Association, FIFA. Right. So it is buy-in to FIFA and its subsidiaries directly and indirectly related to FIFA Under 17 Women's Football Women's World Cup 2020. This was going to be organized in 2020, but due to COVID it is postponed, and therefore they have added that whenever rescheduled, that would be exempted. See, if you see the event, first of all, the organizer is FIFA. Second of all, it is not Asia Cup, it is World Cup. These are the two changes. So you will find two very clear-cut changes. AFC has become FIFA, and Women's Asia Cup has become Women's World Cup. 2022 is Asia Cup and 2020 was World Cup, but Women's World Cup 2020 was postponed indefinitely due to COVID. So whenever the same is rescheduled, that exemption will still hold good. Rather, that Women's Asia Cup point, which is under AFC, is copied from your Women's World Cup 2020. It's actually exactly copied. Even the other points are also there. Even that entry ticket is exempted even for this particular area. So whenever rescheduled is the amendment point. Only one word they have added to that entry. Whenever rescheduled. Whenever it is rescheduled, that exemption will still hold good, because it was planned in 2020, it is still not taking place. So whenever it takes place, obviously services by or to FIFA and its subsidiaries directly or indirectly related to FIFA Women's World Cup 2020 would be exempted. Obviously, again the same point, certification will be by Ministry of Youth Affairs and Sports. Another exemption also will hold good, that entry tickets for that Women's World Cup 2020 will also be exempted. So that will remain true. Only one word has been added here, whenever rescheduled. So that is all about your amendments in relation to sports sector. Now friends, let us go to amendments in exemption for services in relation to government services. So what are the changes that have come in exemption in relation to government services? One new entry have been added. What is that? Services by way of granting national permit to goods carriage to operate throughout India or in contiguous states, either full India or contiguous states. So lot of vehicles get national permit. Lot of vehicles get the right to travel across India, anywhere. of few selected states. So that is called as national permit, and national permit is again given by government. So doubts were raised till now that when this national permit is given by government, obviously the company is getting the national permit will pay a amount, whether that amount is exempted or not. Now understand that before this exemption came into picture, there were doubts whether it is exempted or not. Debates would be there, even the cases would be filed fought in court, but now it is made crystal clear that now onwards it is exempted. Rather, adding this exemption makes government intention more clear. Previously it was not exempted, it is now exempted. So government will always take that defense in court, telling that till the date this amendment was brought out, it was not exempted. So till 1st of October 2021, it was not exempted, only post that it is exempted. Obviously SSC would take a stand that no, when government is now clarifying that it is exempted, it means that earlier also it was exempted. So that issue would be fought in the court. But now for your exams, it is pretty clear that when you talk about national permit for vehicles, goods carriage, obviously that national permit for goods carriage is given by government for traveling throughout India, that is exempted. So that is the first exemption in the government sector. And friends, second amendment in the government sector, first amendment is new entry, second amendment is a change. It was already there, the point was that when you talk about services to government administration for any training program is exempted, subject to the fact that 75% is subject to the fact that 100% of total expenditure is borne by government administration. So when the services is given to government administration for a training program, say for example, right, CBIEC is conducting a training program for which it is taking the help of lot of professionals, right? So services provided by professional to CBIEC, that is government administration. Now previously the point was that for training programs, for training in GST. Now earlier this exemption was there, but with the caution that 100% of the expenditure should be borne by government administration. Now it is said that 75% or more should be borne by government administration. Now what is the implication? The implication is still the point fact holds good that who is the supplier? Supplier is any person. Right, supplier is any person. Recipient is now also government administration only. So recipient does not change. Recipient is government administration. Supplier is any person. Any person. What is the service, friends? Service here is training program. Training programs. As we have discussed that government administration would like awareness in GST to be more, therefore it may hire professionals, not hire exactly, it may take the services of professionals for training in GST. Right. Now previously what was the point, that when it is given to government administration, it has to be made sure that 100% payment is made only and only by government administration. 100% payment is made only and only by government administration, which means that the entire payment should only borne by government administration. Now what amendment has come? Amendment is telling that 100% is not required, 75% is required. 75% of payment should be by government administration, 25% can be by other persons. Say for example, ITC company or Infosys company or Tata company or Reliance company is willing to spend on that government administration as a part of their corporate social responsibility. So that is allowed. So previously they insisted on 100% expenditure being borne by government administration, say for example CBSE. Now they are telling that no, we don't want 100% to be spent by government administration, though government administration is the recipient. 75% spent by them is sufficient. Balance 25% can come from any area, including corporates. So that is the amendment. So they do want only that 75% or more expenditure by government administration. Now balance can come from any person. Right. Now friends, the next set of amendments is there in your charitable trust. So the next sector that we are going to discuss is charitable trust. Now this amendment is amendment due to income tax. It has come here. So when you talk about your charitable trust, there was earlier only one category, section 12AA in your income tax. Now that has been extended to section 12AB also. So there are two categories, 12AA category and 12AB category. In income tax, earlier charitable trust, this section 12AA is coming from your Income Tax Act 1961. So charitable trust category was only one, so section 12AA. Now there's another category, section 12AB. So what have they done? Rather than discussing all these 5 amendments, what have they done? They have found that okay, wherever 12AA is there, we will add 12AB also, right? So wherever in exemption 12AA was already there, they have added 12AB also. First services in relation to services by 12AA entity in relation to charitable activities. Now even it is 12AB entity in relation to charitable activities. Second amendment, they are talking about services by way of training or coaching in recreational activities. But when it is by in sports sector, it should have been given by 12AA entity. Now it can be given even by 12AB entity. So earlier the coverage was only 12AA entity. Now it is 12AB entity as well. Right. The third category is when you talk about old age homes. Right. Old age homes, there was a point that either government can control those old age homes or it can be 12AA category. Now it is central government can manage them or state government can manage them or 12AA charitable trust can manage them or 12AB trust can manage them. The next is services in relation to rehabilitation programs. Initially that rehabilitation program should be under the control of government or 12AA entity. Now it is government or 12AA entity or 12AB entity. So wherever they found 12AA entity, they have added 12AA entity or 12AB entity, right? The last category in here is when you talk about renting of precincts of religious place. Around the temple there will be shops, inside the temple there will be a space for hall, rooms. Now those areas, renting of precincts of religious place, where you are talking about not only the shops around the temple but also a big hall which is part of the temple and rooms in that temple, all of them are exempted but subject to a condition. If it is say for example shop, the amount should be less than 10,000 per month for a shop around temple. If it is a hall, the amount should be less than 10,000 per day for a particular hall, community hall or premises. If it is for room, the amount should be less than 1,000 per day for rooms, right? So that was, these conditions remain the same, less than 1,000 for room, less than 10,000, less than 1,000 per day for rooms, less than 10,000 per day for halls, less than 10,000 per month for shops. Now that was covered for 12AA entity, section 1023C entity, section 1023 BBA entity. Now they have added even 12AB entity, 12AB entity. So wherever 12AA entity was there, they have added 12AB entity as well. So these are the 5 places. These are the 5 places where along with 12AA entity, they have added 12AB entity as well, right? So this amendment is more so over in consequential amendment due to amendment in income tax, where earlier income tax charitable trust was only covered under section 12AA. Now it is also covered under section 12AB. So because of that amendment in GST also they have added along with wherever 12AA they found, they have added 12AB entity as well. Yes, there are a few places where in GST exemption notification still it is only 12AA entity, 12AB entity is not covered. Maybe because of negligence they have ignored it, and you can find the amendments with respect to that in near future also. Now that is all about your charitable trust related exemption. Actually you need not even remember this. Okay, there are 5 areas wherever you found 12AA, they have added 12AB. Basic exemption for charitable activities, they have added 12AB. When you talk about sports related activities, they have added 12AB. When you talk about old age homes and rehabilitation, government was there with 12AA. Now government is there with 12AA and 12AB. When you talk about renting of precincts of religious place, previously it was 12AA, section 1023C and 1023 BBA. Now it is also 12AB is covered. Now friends, the next category of exemption is in your transportation sector, transportation services, transportation sector. A very normal amendment is there. When you talk about this amendment, this was an amendment which was applicable till a particular date. They have extended that day. So when you talk about transportation of goods by vessel or by aircraft, so whether it is by vessel or whether it is by aircraft at the time of export. So when goods are exported by vessel or aircraft, obviously it will be from custom station in India to a place outside India. Earlier that exemption was till 30th of September 2021. Now they have extended till 30th of September 2022. So this exemption now holds good till 30th of September 2022. Right. So transportation of goods at the time of export. Simple language. When you are transporting the goods at the time of export, whether by way of aircraft or by way of vessel. So goods transportation at the time of export. Obviously at the time of export it will go from customs station in India to place outside India. So goods transportation by vessel or aircraft at the time of export from customs station in India to the place outside India. Earlier it was exempted till a particular date, which was 30th of September 2021. Now it is up to 30th of September 2022. So it is extension of that particular date. Still they want that exemption to hold good. So when you see this exemption, it is only extension of that amendment, extension of the date of applicability of exemption, which means that this amendment was applicable till a particular date. Now they want it to be applicable till a particular date. They have extended the validity. The validity has been extended of those exemption. Now friends, the last exemption that we are going to see, this comes under residual sector, which means it is not under any particular category. Earlier categories we have discussed, maybe it was trust category or transportation category. We have seen government category. So category wise we have discussed. We have seen sports category, but now it is residual category. What is the amendment all about? Earlier when you talk about service by way of leasing of assets, whether it is rolling stock assets including wagons, coaches, locos. So leasing of assets belonging to Indian Railway Finance Corporation to Indian Railways. So Indian Railways Finance Corporation is a separate entity, Indian Railways is a separate entity. So earlier when you talk about Indian Railways Finance Corporation giving the assets on lease to Indian Railways, giving the assets on leasing of assets to Indian Railways. Earlier it was exempt, that those assets may be even your wagons, coaches, locos, right? So even when you talk about coaches can be even those assets. So that is owned by Indian Railways Finance Corporation and given on lease to Indian Railways. Earlier it was exempt. Now friends, they want it to be taxable. They tell that okay, we have removed that exemption. Now we want it to be taxable. These are all the amendments when you talk about, friends, your exemption for services. Friends, now let us see the amendments which are there in your document chapter. A small amendment has come in your document chapter when you talk about your e-invoicing. So what is that amendment, friends? When you talk about your e-invoicing, there were few sectors which were exempted from the concept of e-invoicing itself, which means that irrespective of their aggregate turnover, they need not issue e-invoicing. Those sectors basically were, when you talk about your SEZ unit was covered, then when you talk about your banking sector was covered, your goods transportation agency sector was covered, your passenger transportation services, all sectors, I mean all types of passenger transportation services, whether by road, rail, air, etc. was covered. Also when you talk about your multiplex screens, they were covered. Now what has happened is they have added a new line item telling that even this need not issue e-invoicing, government, department and local authority. So basically the amendment is quite simple. Government, department and local authority, now they are added in the list of notified persons who are not required to issue e-invoicing irrespective of their aggregate turnover. So whether their aggregate turnover is crossing 50 crores in any of the financial year, right, starting from 17, 18 or not, forget about it. It may cross, it may not cross, but these all sectors are not covered by the concept of e-invoicing. So what is the latest in the list is government, department and local authority, along with your SEZ unit, banking sector, GTA sector, passenger transportation sector, multiplex screens. Now even government, department and local authority joins the list where they will not be issuing any invoicing. They are not covered by that concept even if their aggregate turnover is exceeding a particular threshold limit. So that is the amendment in your document chapter. Now friends, let us focus on your amendments in your registration chapter. Amendments in your registration chapter. The first amendment is with respect to your section 25 subsection 60. There is a notification 3/2021 which is now added. Now what is notification is trying to tell? This notification is merely a kind of clarification. Now already when you talk about few notified persons, right, when you talk about an individual who is not a citizen of India, or when you talk about non-individuals, namely department or establishment of central government, state government or local authority or a statutory body or a public sector undertaking, or those who are required to take unique identification number. So these were the sectors: individual who is not a citizen of India. Second was a sector where non-individuals, where you are talking about government, local authority, statutory body, public sector undertaking, and also when you talk about UIN, they were not required to go for Aadhaar authentication. Aadhaar authentication is not applicable for them. Now what has been added is for a newly registered person, Aadhaar authentication was not required for these sectors. So one thing was pretty clear for these points: when you are going for new registration, Aadhaar authentication is not required. So if you are going for new registration, it was pretty clear that Aadhaar authentication is not required. Aadhaar authentication is not required. The problem was for existing registration. If at all you are already registered, you have to apply for Aadhaar authentication within a particular time that government will tell. Now they have made clear that even if they are already registered, which is covered under section 25(6)(a), even for them Aadhaar authentication is not required. Basically, if I want to categorize it, section 25(6)(a) is talking about already registered person. Section 25(6)(b) and 6(c) is talking about new registration, right? So 25(a) already registered, 25(6)(b), 25(6)(c) new registration. Now what has come and what has been made very clear, it is only clarificatory nature. 25(6)(d) tells that Aadhaar authentication is not at all required for select persons. Right, 25(a) is for Aadhaar authentication for already registered person. 25(6)(a), 6(b) is for Aadhaar authentication for newly registered person. 6(d) tells that Aadhaar authentication is not at all required. Now earlier the coverage was Aadhaar authentication was not required for newly registered person. Now they are telling that Aadhaar authentication is not at all required for already registered person, not for everyone, for notified categories, for notified persons. Now what are the notified persons that we have already seen? This is actually a clarification. When for a particular sector, for a particular set of people, you don't require Aadhaar authentication for new registration. Obviously, for if they are already registered, then also Aadhaar authentication you need not do, you need not even think of it. So that is only a clarification which has been now set. Now friends, next point or next amendment in your registration chapter is all about authentication of documents on your electronic portal, right? So it is all about e-verification. Rule 26 sub rule 1, proviso to rule 26 sub rule 1 is now omitted. What was that proviso telling about? Proviso was telling that if at all you are talking about person covered under Companies Act 2013, that is companies and LLP, their document on portal should always be through digital signature certificate, which means when you talk about portal, you do a lot of things. You take registration, you make payment, you file your returns, etc., etc. You file DRC03 or you file other documentation, you go for appeals, everything is happening on portal. So anything that you communicate on portal should be authenticated. Earlier for companies and LLP covered under Companies Act 2013, what they had to do, authentication was possible. Authentication was possible only by way of digital signature certificate. Now they can do authentication, they can use the DSC if they want, but now it is possible even by way of electronic verification code. So if at all I am talking about a proprietorship concern or a partnership firm, earlier they had an option either to authenticate the document by electronic verification code, or if you have DSC, DSC is also fine. People will generally go for EVC. It's a very simple method where you will get a one-time password in your mail ID and your mobile number, and you give that, it is filed. DSC was not required. For whom? For other than companies and LLPs. But for companies and LLP, earlier DSC was mandatory. Now what has happened after the amendment, whether it is company or LLP or partnership firm or proprietorship concern or etc., etc., Now they can all authenticate the document by way of EVC, that is electronic verification code. A simple OTP will come and you have to give it, or by way of DSC. So a very simple amendment has come in. So if you want to understand in this way, company, LLP, others, before amendment, after amendment. Before amendment, companies and LLPs. Companies and LLPs could submit their document only by way of DSC, could authenticate only by way of digital signature certificate. Others, they can authenticate the document by EVC or DSC, whatever method they want. After amendment, whether it is companies or LLP or others, including partnership firm or a proprietorship concern or a AOP, HUF, etc., they can have any option. They can authenticate their submission on portal through electronic verification code, or they, if they want, they may use digital signature certificate. So that is the effect of your amendment in your Rule 26 sub rule 1, because proviso to Rule 26 sub rule 1 is removed. Now friends, again the next amendment in your registration chapter is about revocation of cancellation. When your registration is cancelled by proper officer, you can still revoke your cancelled registration within a particular time limit. Now that amendment is now there in Rule 23 sub rule 1. Now once your registration is cancelled by proper officer, you still have a second chance to make that registration again alive. The time limit to apply for that revocation application is 30 days basically, but that time limit can be extended by additional commissioner, joint commissioner, or the commissioner. That is first extension and that is second extension. So basically the time limit is 30 days basic time limit, second is extension by joint commissioner, additional commissioner, next is second time extension by commissioner. Now this already came out last time, right? It is this amendment in your Rule 23 sub rule 1 is only clarificatory nature. Why is it so? Because it is consequential to the amendment done in section 30 subsection 1. Already section 30 subsection 1 has already said that 30 days can be extended by additional commissioner, joint commissioner, or the commissioner. But in procedural part, what is the procedural part, friends? In procedural part, which is all in your Rule 23(1), they did not mention about that extension. Now what have they done? In the procedural part also they have mentioned about that extension. So an extension which was given in section 30, now it is brought into the procedural part, Rule 23. It's only clarificatory in nature, so nothing special, it is only a clarification that has been given. Now friends, let us discuss about the amendment again which is there in your payment chapter. So when you talk about amendment which is there in your payment chapter, again nothing major, we are talking about section 51, that is proviso to be very specific, proviso to section 51, which talks about interest on delayed payment. Now what is the amendment, friends? Already your section 50 has been amended last time to tell that at times interest will be only on cash ledger, but generally interest will be on cash ledger plus credit ledger portion both. So at times when whatever payment you are making by cash ledger, interest will be only on that portion, and if at all you are not covered by the general special position, then interest will be on your entire payment gross liability, whether paid by credit ledger or cash ledger. Now this is exception, which means that interest will be only on your net liability which is paid by your cash portion. Now what have they in fact amended? Again this amendment also, friends, is only clarification. First thing that they have made is, now they have made this amendment retrospectively effective from 1st July 2017. So there are two parts of it. This amendment already came out, but now they have said that this would be applicable not from the date of amendment that came out last time. They will telling that right from the day GST was born, this retrospective amendment is given to benefit the assessees. Department have a bad habit of asking interest on gross liability. Say for example, my gross liability is 100 crores. I have ITC of 80 crores. 20 crores is the only payment that I pay by cash ledger. So this is my gross output tax, this is my ITC, and this is my net output tax. Now ITC portion is payment by your credit ledger, and 20 crores is payment by your cash ledger. Now last time when proviso to section 51 came out, it said that in special cases interest will be only on cash ledger portion. Normally interest will be on 100 crores. Normally interest will be on 100 crores. Special cases interest will be only on 20 crores. So normally interest is on gross liability. What is the special case when it is on net liability? That special case was, friends, if at all in a scenario where you are talking about supply was made during a tax period and return for that tax period was filed after the due date, which means that supply of October shown in October but filed late. Supply of October shown in October but it is filed late. And even proceedings should not have commenced. Section 73, 74 proceedings should not have commenced. Right. If supply is of October but it is shown in December month, interest will be on gross liability. So normal scenario, they tell that interest is always on gross liability 100 crores, which will be huge. Special scenario, interest is on net liability when supplies of a particular month shown in the return of that particular month but after the due date. So you have reported only in that month, you are not reporting in subsequent months, you have reported only in that month but you have filed your return late. And 73, 74 proceedings should not have started. Before proper officer starts, you should do on your own. Right. Supply of that month shown in that month but late, plus 73, 74 has not commenced, then they said that interest will be on only that portion which is paid by using your electronic cash ledger. Earlier the language used was levied, now they have changed it to payable. The amendment is only this much. Levied would cause problem in future because interest, there is no levy of interest, rather it is all about payment of interest. Levy is of your tax. So they have just realized that rather than using the word levy, better term would be payable, because they are not talking about tax, they are in fact talking about interest. So if it is all about tax, levy would have been the right word, but as it is all about interest, they have thought that okay, levy word would not be the right word to use, therefore they have changed the term levy to payable. Actually the amendment is only this much, all the other areas was already there. The amendment is levy is changed to payable. They do not want to use the word levied for interest because levy is of tax basically, therefore they thought that okay, levy word would not be accurate for interest, they have changed that to payable. So that is all about the amendment in your section 50 subsection 1. Welcome back friends. Now let us see the amendments in your return filing chapter. Now to be very specific, return filing chapter is a chapter which has got maximum amendments with respect to your May 22 exams. The first amendment that you are going to see is in section 44 read along with your rule 80, which is talking about your annual return GSTR 9A. Basically when you see the introduction part of your annual return, what changes they have done? They have made changes in the language, right? Now before we go into the language, understand that your regular taxable person is required to file GSTR 9 and your composition taxable person is required to file GSTR 9A. So this remains the same before the amendment, after the amendment this remains the same. Your regular taxable person GSTR 9, composition taxable person GSTR 9A. Now what changes they have done is, they have said that all registered person other than ISD, casual taxable person, non-resident taxable person, TDS, TCS, put in a simple way, the category which was covered for your annual return remains the same. Regular taxable person, composition taxable person. They were the same before amendment and after amendment. Now what changes they have done is brought the changes in the language. They have said that they are required to file annual return along with which may include a self-certified reconciliation statement. Friends, what is this reconciliation statement? Previously it was called as 9C, now also there is GSTR 9C only. The difference is previously if at all you talk about your turnover exceeding a particular threshold, you are required to file GSTR 9 registered person and 9 C was actually filed by a chartered accountant or a cost accountant. Now let me put this difference in this way, right? So first you are talking about regular taxable person, then you are talking about composition taxable person. Regular taxable person, two categories. First you are talking about GSTR 9 only if your turnover is less than a particular limit. But if your turnover is more than a particular limit, then you are required to file GSTR 9 plus GSTR 9C. And if you are a composition taxable person, it is only GSTR 9A. Now, doubts will come as to what amendment has brought in. This 9C is nothing but a reconciliation statement. Now, this previously reconciliation statement was actually certified by a chartered accountant or a cost accountant. Now, it is self-certified. Now, it is self-certified. So, if I am a regular taxable person and if my turnover is less than the particular limit which requires reconciliation statement, I will file only GSTR 9. And if my turnover is more than the limit which requires reconciliation statement, I will file GSTR 9 and 9C, which is nothing but an attachment or reconciliation statement to GSTR 9. Now that reconciliation statement is self-certified. And if you tell that no, I am a composition taxable person, then the moment if you tell that you are a composition taxable person, no need to worry, you are going to file GSTR 9A. So the first change that they have brought is the language self-certified reconciliation statement. The reconciliation statement will reconcile these values between your annual return GSTR 9 and your audited annual financial statements. That is the purpose of reconciliation statement, reconciling what is there in your annual return GSTR 9 and reconciling the values in your audited annual financial statements. Previously it was purpose was the same, now also purpose is the same. Difference is now it is self-certified. Now one may wonder what is GSTR 9B then. 9B was there previously also, now also there is no amendment. 9B is nothing but an annual statement which is filed by electronic commerce operator who are having TCS, right? TCS collector. So your GSTR 9B is filed by TCS collector. This was there before and this is there even now. Why it is not covered here? It is not as per section 44, it is as per section 52. So 9B is to be filed by electronic commerce operator who is collecting TCS and it is actually under section 52. Now the next amendment that they have brought in, this is the first amendment, the language. The first amendment that they have brought in is the language. Second amendment and third amendment. This next amendment that they have brought in is, the next amendment focuses on commissioner having the powers to notify people, class of registered persons who are not required to file annual return. So commissioner now is having the powers to exempt a particular class of registered persons from filing of annual return. Obviously commissioner will do it on the recommendation of council, but commissioner is now having that powers to tell that few class of registered persons you are not required to file any annual return. So that amendment has come in. Now it is under section 44. The next amendment that is there, another amendment that is there is, previously when you talk about department of central government, state government or local authority, right, where CAG whose books of accounts are subject to audit by Comptroller and Auditor General of India or an auditor appointed for auditing the accounts of local authority, they are not required to file annual return. You may tell that this provision was there before also. Yes, it was there before also, but an important point. Previously, this provision was, this relaxation was only from filing of GSTR 9C. So previously when you talk about a department of central government, state government or local authority whose books are being subject to audit by CAG or any other auditor appointed for auditing the accounts of local authority, previously they are required to file 9 but not 9C. Now they are not required to file 9 as well as 9C. So if you see this amendment, first amendment is it is brought in section 44 from, previously this was relaxation was in section 35. Section 35 is talking about reconciliation statement. So it is shifted from 35 to 44. And when it is shifted, even the language is changed to such extent that now they are not required to file 9 also. Previously they were required to file 9 but not required to file 9C. So when you talk about what you are talking about, the department of central government, state government or local authority whose books are being subject to audit by Comptroller Auditor General of India or any auditor appointed for auditing the books of local authority. What was the previous point? Previous point before amendment, they were required to file GSTR 9. GSTR 9C was not required irrespective of turnover, and previously the coverage was under section 35 subsection 5 before amendment. Now they are not required to file GSTR 9 as well as GSTR 9C because this provision itself has come under section 44. This relaxation itself has come under section 44. So situation before amendment and situation after amendment is totally different. One, switching over from section 35 to section 44. Second, previously relaxation was only 9C from GSTR 9C. Now no need to file both 9 as well as 9C. So that is the amendment that they have brought in, the third amendment. And friends, the fourth amendment that they have brought in is the due date which was previously under rules. Now it has brought under section. So previously due date was given in rule 80. Now it is brought in section 44 itself. So the due date remains the same. There is no change in due date. The due annual return shall be filed on or before 31st of December of succeeding financial year, and it can be extended by commissioner. So that remains the same. The difference is previously it was covered rather under section under rule 80. Now time limit was under rule 80. Now it is brought in section 44. So these are the amendments that have been brought in your section 44 read along with rule 80. Now friends, you are talking about timing relaxation for your GSTR 9. Again, for financial year 2020-21, annual return is optional for those who are having aggregate turnover up to 2 crores, which means if it is your aggregate turnover it is less than 2 crores, you are not required to file GSTR 9, or if you want to file, it is optional. So annual return is optional for those assessees whose aggregate turnover is less than 2 crores, right? That is only relaxation for a particular year, that is financial year 2021. This continues right from the beginning. Now friends, an important point to understand and analyze. Let us categorize it. What is the final answer for your financial year 2021 and 21-22 onwards? I have to categorize it, the turnover, into 3 parts. You will understand why we are categorized into 3 parts. First, turnover up to 2 crores, 2 crores to 5 crores, more than 5 crores. Turnover up to 2 crores for financial year 2021 up to 2 crores, filing of annual return is optional. You may file, you may not file. Obviously 9C is not there. And from financial year 21-22 onwards, unless otherwise there is a specific relaxation for 21-22 also, 9 is required to be filed, but 9C is not required. And if your turnover is from 2 crores to 5 crores, more than 2 crores but up to 5 crores, then you are required to file GSTR 9 but no 9C, whether it is financial year 2021 or 21-22 or any financial year. So 9 is required, 9C is not required. And friends, if your turnover is more than 5 crores, you are required to file GSTR 9 as well as 9C, which is self-certified, whether it is financial year 2021 or 21-22 or any financial year there onwards, right? So if you see this chart, things are pretty clear. Up to 2 crores only GSTR 9, right? And that too, it is optional for a particular year. Rather, if I want to tell in a very common language for all the financial years, up to 5 crores only GSTR 9, no 9C. More than 5 crores 9 and 9C. Up to 5 crores only 9, more than 5 crores both 9 and 9C. Then you will tell why the 2 crores relaxation has come. 2 crores relaxation has come only for financial year 2021. So if at all I am talking about a general provision, then up to 5 crores only GSTR 9, more than 5 crores 9 plus 9C, GSTR 9 plus GSTR 9C. But for financial year 2021, we have significance of 2 crores also, because up to 2 crores filing of GSTR 9 is optional. Filing of GSTR 9 is optional. So that relevance has come here only and only because of your financial year 2021. So if you forget about financial year, if you want to know the general answer, up to your aggregate turnover is up to 5 crores, then only GSTR 9. Is more than 5 crores, then GSTR 9 plus self-certified GSTR 9C. Right, that is all about your GSTR 9, specifically section 44. Now friends, let us discuss about 9C in more detail. Rather, though we have discussed all these points already, but still we'll focus on your rule 80, specifically what all amendments have come in rule 80. Friends, when you talk about your rule 80, which is about reconciliation statement, we have already discussed about this 9C, but still we'll walk through it to see whether all the points were covered. Now 9C is not required to be filed by whom all? If you see the list, 9C is not required to be filed by your ISD, casual taxable person, NRTP, TDS deductor, TCS deductor, Department of Central Government, State Government, Local Authority. We have already discussed that, whose books have been subject to audit by CAG or any auditor appointed for auditing the books of local authority. All these points you have seen. Same thing. Put in a nutshell, normally your GST 9C is required to be filed by whom? Regular taxable person. You may ask why composition taxable person is not covered. Composition taxable person files 9A. 9C is an attachment to GST 9. So it is all actually filed by your regular taxable person. Now there is a turnover limit that we are discussing just now, whose aggregate 9C is required to be filed by a regular taxable person whose aggregate turnover exceeds 5 crores. Whose aggregate turnover exceeds 5 crores, he shall give self-certified reconciliation statement reconciling the figures between your GSTR 9, that is annual return, and annual audited financial statements. So 9C will act as a reconciliation statement between GSTR 9 annual return and annual audited financial statements. And obviously due date for that remains the same, it is 31st of December of succeeding financial year. So if I am a regular taxable person whose turnover is more than 5 crores, I have to file GSTR 9 plus GSTR 9C, and both of them has to be filed before 31st of December 2000 of the succeeding 31st December of the succeeding financial year. So that remains the same. What difference has come out is threshold limit of 5 crores is mentioned in rule itself. Previously that limit was not there. Second, now it is self-certified. So if you see the amendment, you will find this point pretty clearly, that reconciliation statement is required to be filed only if the aggregate turnover exceeds 5 crores. So if I tell if my aggregate turnover is only up to 5 crores, I will file only GSTR 9. If I tell that my aggregate turnover is more than 5 crores, then I will file GSTR 9 along with GSTR 9C. So that is the first amendment. Limit is specified in rule itself. Second amendment that they brought it in is, now reconciliation statement. Your reconciliation statement is self-certified. Certification by chartered accountant or cost accountant is not required. A very important point. Certification by CA, CW is not required. Therefore, section 35 subsection 5 itself is not relevant. So section 35 subsection 5, which was talking about reconciliation statement, is not at all relevant now because it is brought in rule 80 itself, and certification by CA, CW is no more relevant because it is self-certified. So two amendments have been brought in. Limit for reconciliation statement is brought in rule itself, which tells that limit is 5 crores. If your turnover is up to 5 crores, please only file GSTR 9. If your turnover is more than 5 crores, please file GSTR 9 and GSTR 9C, which is reconciliation statement. And moreover, it is self-certified now is sufficient. Now friends, let us see the amendments in your late fees. They brought out some amendments in your late fees. Rather, they have rationalized late fees. Late fees was too high. Rupees 100 per day subject to a maximum of 5,000 was late fees. So they thought that late fees amount is very higher amount. So they thought that let us rationalize the late fees. Now what have they done with respect to your late fees? They have rationalized, or they have minimized the late fees. If I talk about GSTR 1 and your GSTR 3B. GSTR 1 talks about your outward supplies by regular taxable person and casual taxable person. 3B talks about your return by regular taxable person and casual taxable person. Both are filed by a regular taxable person, casual taxable person. Late fees now is CGST late fees is 100 rupees per day or subject to a limit 100 rupees per day for every day of delay or subject to below table. Copy paste SGST. Here also same, CGST is 100 rupees per day of delay subject to maximum of the table. Now what is the table telling about? Table, both the tables tells the same thing, so we'll take only one table. If at all you have nil transactions, if you don't have any transaction in GSTR 1 or if you don't have any transaction in GSTR 3B, then the high upper limit is CGST 250. Obviously SGST is 250 also same. If at all it is other than nil transaction, which means normally there are some transactions to be reported, then if your aggregate turnover is up to 1.5 crores in preceding financial year, then the upper limit is CGST 1000. Right, same here. If your aggregate, if at all it is other than nil transaction, some transactions are there, and if your aggregate turnover is up to 1.5 crores in the preceding financial year, the maximum amount is CGST 1000. Obviously SGST is also 1000. And if I tell that if it is a normal return, other than nil is normal return, and if your aggregate turnover is more than 1.5 crores, if your aggregate turnover is more than 1.5 crores but up to 5 crores, it is maximum CGST late fees is 2500, 2000, SGST late is 2500. To put in a very simple way, nil transactions, nil returns, GSTR 1, GSTR 3B, maximum limit is 250. Normal returns, last year turnover is up to 1.5 crores, maximum limit is 1000. Normal returns, last year aggregate turnover is between 1.5 CR to 5 CR, it is 2500 is late fees. If it is normal return and last year aggregate turnover is more than 5 crores, then it will be normal, that is 5000 rupees. Let us see this with the help of example. Right. If I'm talking about a regular taxable person or a casual taxable person who has to file 1 and 3B, supposing it is a nil return, nil outward supplies or nil tax payable. If it is a nil return, forget about the previous year aggregate turnover. Your previous year aggregate turnover is not at all relevant, whether it is 40 days delay. We will take the same. Your previous year aggregate turnover, whether it is 1 crore, 4 crore, 7 crores is not relevant. It is 40 days delay. So late fees will be lower of 100 rupees per day. Lower of 100 rupees per day, which is 4000 or 250. So CGST late fees is 250. In all the cases, CGST late fees is 250. Obviously, SGST late fees will be 250. Friends, understand that if at all you have a nil return, nil outward supplies and nil tax payable, nil outward supplies for 1 and nil tax payable for 3B, forget about previous year aggregate turnover. It is rupees 100 per day. So 100 per day means 100 for 40 days, 4000 or 250, whichever is lower, 250. So CGST late fees is 250. In all the three cases, copy paste is SGST late fees. But friends, if I take the same case, exact same case, and if I tell that I am a regular taxable person or a casual taxable person where my 1 and 3B is other than nil, when I tell other than nil, it is a normal return. Then my previous year aggregate turnover is very important. If it is 1 crore, what will be the late fees? Rupees 100 per day for 40 days, which is 4000, or 1000, which is lower? 1000 is lower. CGST late fees is 1000, copy paste SGST late fees. If my previous year aggregate turnover is 4 crores, 40 days delay. So again, rupees 100 per 40 days, which is 4000, lower of 4000, or if my aggregate turnover is between 1.5 CR and 5 CR in previous financial year, then the upper limit is 2500. So previous case was 4000 or 1000, answer was 1000. Now it is 4000 or 2500, answer is 2500. 2500. This is CGST late fees, copy paste SGST late fees. But if I tell my previous year aggregate turnover is 7 crores, right, it is not in first category less than 1.5 CR, it is not in second category 1.5 CR to 5 CR, it is in normal category, then rupees 100 per day, rupees 100 per day is 4000, 100 per 40 days 4000, or limit is 5000, limit is 5000. which is lower? 4,000. So in the first case, it was, the limit was 1,000 because previous year aggregate turnover was up to 1.5 crore. In the second case, the limit is 2,500 because it was between 1.5 crore to 5 crore. In the third case, the limit was, upper limit was 5,000 because it is more than 5 crore in the previous financial year. So that is the amendment that they have brought out. So that is all about your rationalization of late fees for 1 and 3B. Now when you talk about rationalization of late fees for your GSTR 4 annual return, that is written by composition taxable person. Again, CGST late fees will focus rupees 100 per day of delay or below table, whichever is lower. What is the below table? If the transaction is nil, if it is a nil case, nil return case, then the upper limit is 250 for CGST and 250 for SGST. Other than nil case, it is 1,000. Irrespective of turnover, it is 1,000. Nil case 250, other than nil case, it is 1,000. Now to understand this, we will take a very simple scenario. Composition taxable person. So for composition taxable person, last year aggregate turnover is not relevant. GSTR 4 is going to file. If at all it is a nil return, if at all it is a nil return, nil tax payable, then for 2 days delay, 2 into 100 per day, subject to maximum of 250. 8 days, 8 into 100 per day, subject to maximum of 250. 32 days, 32 into 100, subject to maximum of 250. So in the first, in all the 3 cases, for upper limit is 250, 250, 250. In the first case, your answer will come as 200 or 250, which is 200. Second case, 800 or 250, 250. Third case, 3,200 or 250, it is 250. Simple. 100 rupees per delay, per day of delay, or 250, whichever is lower, nil cases. If I tell it is other than nil cases, which means there is some tax payable, then for 2 days delay, 100 rupees per day for 2 days, subject to maximum of 1,000. So 200 or 1,000, answer will be 200, whichever is lower. If it is 8 days delay, 800, that is 800 per 8 day, which is 800, or 1,000, which is lower, again answer is 800. If it is 32 days delay, 100 multiplied by 32 days, that is 3,200 or 1,000, which is lower, 1,000. So if it is other than nil cases, the upper limit is 1,000. The upper limit is 1,000. In composition taxable person, your previous year aggregate turnover is not at all relevant. All you have to see is it is nil case, slab is 250, 100 rupees per day of delay, or 250, which is lower. If it is other than nil case, it is 100 rupees per day of delay, subject to maximum slab, which is 1,000. That is for your GSTR 4. This is CGST late fees. This will be copy paste for SGST. So whatever late fees we are discussing is for CGST, copy paste for SGST. Now friends, the next rationalization of late fees is for your TDS, right? So for your TDS return, GSTR 7, the late fees that they have said is, they have changed that 100 rupees per day also. It is 25 rupees per day of delay or below table, that is maximum late fees 1,000 CGST and 1,000 SGST, copy paste. 25 rupees per day. That is a very important point. Normally late fees in all the other cases that we have discussed is rupees 100 per day of delay. Here late fees is rupees 25 per day of delay, unlike all other cases where it is rupees 100 per day. Here per day continuing late fees is 25 per day, very very important. And in any case the upper limit is 1,000, upper limit is 1,000 rupees, right? So if at all I am talking about your TDS deductor, GSTR 7, 10 days delay, 45 days delay, 100 days delay. What is the late fees? Friends, important point is late fees is 25 per day of delay for 10 days, 250, or 1,000, which is lower, it is 250. If it is 45 days delay, 25 multiplied by 45, right? So that will be the figure, and compare it with 1,000. Obviously seeing the numbers, obviously 1,000 will be lower one. This is CGST late fees, copy paste for SGST. And if it is 100 days delay, so 25 multiplied by 100 days, compare with 1,000. Compare with 1000. So 2500 or 1000, which is lower, CGST late fees is 1000. Interesting point is upper limit in all the three cases is 1000 rupees, and per day in all the three cases is rupees 25. It is not rupees 100. Right, normally you have to work out. And if I want to compare this with your other returns, supposing if I am talking about other returns like your NRTP return, just a comparison, non-resident taxable person return GSTR 5 or ISD return GSTR 6. Friends, here there is no race realization. Race realization has come only for GSTR 1, 3B, GSTR 4 and GSTR 7. Yes, government in terms of section 128 can rationalize late fees for other types of returns, which it has done, but IC has not given them a material. So we'll go up as per the provision. For other returns, whether it is GSTR 5 or GSTR 6, the late fees is in this fashion. It is normal 100 per day, maximum 5000. So 10 days means 10 days delay means 100 per 10 day 1000 or maximum 5000, which is lower. CGST late fees is 1000, copy paste for SGST. 45 days delay means 100 per day of delay, 100 rupees for 45 days, 4500, or compared to 5000. What is lower? 4500. Same say late fees for SGST. This is CGST late fees. 100 days delay means 100 multiplied by 100, which is 10,000, compare it with 5,000, which is lower, 5,000. So for other returns, the upper limit is 5,000, which is as per section 47, 5,000. Right, friends, whether there is a rationalization for this fees? Yes, there it is. The government has rationalized late fees for them also in terms of section 128, but IC has not covered this in your syllabus. Therefore, we are going for late fees, which is as per section 47. That is the difference that we are doing. And late fees for annual return, friends, it remains the same. Late fees for annual return was the same before amendment, is the same after amendment. So just for understanding purposes, late fees for annual return was your rupees 100 per day, subject to maximum of 0.25% of state turnover. Rupees 100 per day, subject to a 0.25% of state turnover. That is the late fees for your annual return. So there is no change. So I am not discussing this example. It is same. Rupees 100 per day, subject to a maximum of a percentage, 0.25% of state turnover. 0.25% of your state turnover. So that you have to remember. Friends, that is all about your amendments in your return filing chapter. Basically, the amendments you can categorize them into two. One, amendment in your annual return and reconciliation statement 9C. Other amendments in your late fees. Basically, the legislation was for 1, 3B, 4 and 7 specifically. Now friends, coming to your e-waybill chapter, there is an amendment in Rule 138E which talks about blocking of e-waybill. What is that amendment? The amendment goes in this way: notwithstanding anything contained in Rule 138(1), no person, including a consignor, consignee, transporter or electronic commerce operator or a courier agency, be allowed to furnish Part A of GST e-waybill 1, which means no person can generate e-waybill. Before the amendment, the language was in respect of a registered person, whether as supplier or recipient. Now the language is in respect of outward movement of goods of a registered person. See the change. Previously the coverage was wider. This blocking of e-waybill in terms of 138E was in respect of a registered person, whether he is acting as supplier or recipient, both for inward supply, outward supply. Now it is only for outward movement of goods of a registered person. Now friends, if you want to understand this, let us take this example. Supposing consignor is VJ Limited, consignee is PJ Limited. Blocking is done for VJ Limited. Coverage, who is covered in 138 is VJ Limited, which means he has done some activity which is not allowed, therefore blocking of e-waybill is done for VJ Limited. Now this is outward supply by VJ Limited. So before the amendment he cannot generate e-waybill, now also he cannot generate e-waybill. That is the first category. Second category, VJ Limited is sending the goods to PJ Limited. Blocking is done for VJ Limited. VJ Limited has done something which is not in accordance with your e-waybill. Blocking is for VJ Limited, 138E. Now it is an inward supply for PJ Limited. Inward supply for PJ Limited. Before the amendment, e-way bill cannot be generated in this case also, but here it can be generated, right? It can be generated, assuming that it is inward e-way bill by PJ Limited, it can be generated. Why? The restriction is only for outward movement of goods by a registered person, outward movement by VJ Limited. So if e-way bill is created by PJ Limited as inward e-way bill has two categories: outward e-way bill, inward e-way bill. If PJ Limited wants to create e-way bill for its inward movement, PJ Limited can do it. Restriction is for VJ Limited, PJ Limited can do it. The next category, PJ Limited to VJ Limited. Violation is done by VJ Limited. In all the cases, violation is done by PJ Limited. Now outward e-way bill is to be generated by PJ Limited. Before the amendment, it was not possible. After the amendment, it is possible. After the amendment, it is possible because outward e-way bill by VJ Limited is blocked. In all the cases, you have to remember that if it is outward e-way bill by VJ Limited is not allowed. Other cases it is allowed. The last case will take PJ Limited, VJ Limited. The violation is done by VJ Limited, who is covered under 138E. Now, inward e-way bill is to be generated by VJ Limited. VJ Limited wants to generate inward e-way bill. Before the amendment, it was not possible. After the amendment, it is possible. If you see carefully, whenever e-way bill is to be generated by PJ Limited, he can do it. Though the other party is VJ Limited, but he can generate e-way bill, whether it is outward e-way bill by PJ Limited or inward e-way bill by PJ Limited. And when you talk about VJ Limited, if it is inward e-way bill by VJ Limited, it is possible to do it. Only restriction is for outward e-way bill by VJ Limited, not possible. Not possible. So if the subject person, the person who has done violation is VJ Limited, who is covered under rule 138E, so all these categories can be there: outward e-way bill, inward e-way bill, outward e-way bill by VJ Limited, outward e-way bill by PJ Limited, inward e-way bill by VJ Limited, inward e-way bill by PJ Limited. Only what is not allowed is outward e-way bill by VJ Limited, not allowed. All the other three cases, e-way bill can be generated. So if at all it is outward e-way bill by PJ Limited, allowed. Inward e-way bill by PJ Limited, allowed. Inward e-way bill even by VJ Limited, allowed. Restriction remains only for outward e-way bill by VJ Limited, who is covered under 138E, not allowed. So that is the effect of amendment. Obviously, one party is VJ Limited in the transaction, only then this entire example or discussion holds good. So that is all about your amendment in your e-way bill 138E.